Is this a good time to purchase a home? This is a main question I've been fielding since the stock market took a crash on Monday, all related to the jobs and unemployment report that hit the markets last Friday. And it's a good question to ask. Since Monday, investors began the scramble between the stocks and the safety net of the U.S. Treasury markets, as cracks in the U.S. economy surfaced due to the restrictive policies of the Federal Reserve. While economists and investors alike have been screaming recession due to those events, coupled with indicators that have been present for the better part of 2 years now, the National Bureau of Economic Research still has not came out and said the word recession yet. And the FOMC is sprinkling sugar on the issue, basically trying to say that it was a one-off fluke. So it begs the question, does the Fed see something that we don't, or are they just being stubborn again? Have they held the federal funds rate too long? Well, in this video, we're going to analyze all that and see if a window of opportunity may be opening for buyers in the near future. To analyze the question, is this a good time to buy, really revolves around one question. And that is a question that resulted in Monday's market crash in the stocks. What is going on with unemployment? As we know, the unemployment of the jobs report from last Friday did not show promising numbers and actually showed a crack in the U.S. economy. If you're not already aware, last week, and according to the projections, unemployment was expected to hold firm at 4.1%. Instead, it rose to 4.3%. And to compound the issue, the U.S. economy was expecting to add 185,000 new jobs. Instead, the projection took a crushing blow, showing just a mere 114,000 jobs created. Somewhat smaller to the issue, yet compounding, ISM manufacturing data the day before significantly dropped below projections to 48.6, to a level that sounds the alarm to investors. And U.S. wages decreased from 0.3% to 0.2%. In a nutshell, this data indicated to investors a significant negative economic shift. And when the markets think the economy is moving in a bad direction, stocks sell off, leading to the investor scramble from stocks to the safety of the U.S. securities. And boy, did they. Good for mortgage interest rates and bad for stocks. Since Monday, however, the markets have been going back and forth with a general upward trend, analyzing nervously in attempts to find stability within the new data and the Fed's reaction to it. This leads us to our first question in the video. What is happening with employment in the United States? Based on the available data and according to the BLS, which I really hate to reference, in a 12-month comparison, few industries in the United States have taken employment hits overall. And other graphs, like what's available in Fred graphs, will show you that full-time job employees are healthy, as well as multiple job holders. So while I can attempt to look for cracks in the U.S. labor trends, the simple truth is I'm really not going to find them yet. So if I can't find cracks in employment trends, what can I look for to show the health of the U.S. industries? Well, how about their pocketbooks? For reference and the sake of not overloading this video, the net profit margin is often considered the most comprehensive measure of overall profitability of industry and in companies in the U.S. Some of the more notable industries that are having issues as of late are airlines, biotech, advertising, believe it or not, drug manufacturing, health information services, medical services, solar, and some others. But for the sake of breaking it down to a broad look at the cracks, let's take a look at the net profit margins in all three major indexes. The net margin for the S&P 500 was on its way down until about mid-June of last year, the Dow Jones until January of 2024, this year, and the NASDAQ is still on its way down. So overall, the net profitability of companies has been on the decline. But due to what? Well, you guessed it, the federal funds rate. But Mike, how does this happen? When the federal funds rate rises, it affects profitability through impact on borrowing costs, consumer spending, investment costs, and overall economic conditions, things we have mentioned in prior videos. When borrowing then becomes more expensive, it leads to higher interest expenses for companies, which reduces net profitability. And what usually happens when you strike a company in the pocketbook? Well, you also guessed it, layoffs. When a company's net profitability declines, one of the most common responses is layoffs. Then it attempts to manage the reduced financial performance and lower labor costs to improve profitability. While the decision helps reduce expenses quickly for a company, it can also impact employee morale as well as the company's operational capacity. So there are some drawbacks to the companies as well when they do this. So given the net profit outlook of these U.S. companies, things may look like they are improving on the surface. However, overall, the companies have been losing money. And as the overall unemployment rate in the US has been ticking up since March of this year, given this and from an investor's point of view, it is no surprise that the markets reacted the way they did when unemployment spiked up 0.2% from Friday's unemployment data. And as global markets made downturns around the world. But Mike, I've been looking online and listening to the news. All I'm seeing is layoffs happening all over the place. Well, all over the place? Well, maybe not all over the place, but how about in tech specifically? Let's take a look at tech. If you do a basic Google search and you are listening to the evening news, then yes, you're right. You have been hearing about a lot of layoffs in tech companies. But why is that? It's because of the change of focus of many companies to artificial intelligence or moving to work with AI-based tools. But not every layoff move leads to a reduction in jobs. Instead, according to articles, data show that specific tech companies simply replaced employees with certain skill sets and employees possessing other talents, particularly in the AI field. For example, according to an analysis by CompTIA, the number of open jobs that were related to AI required skills in the field increased from about 2,000 in December of 2023 to 14,479 in January of 2024. The number of vacancies in January of 2024 also increased by 18,000 as compared to December of 2023. But while the numbers showed an increase in employment, these were also cases where job cuts were made due to a transition to the use of AI. And instead of hiring thousands of employees every quarter, companies preferred to invest in the development and implementation of AI capabilities. So while overall this seems to be a positive employment trend for tech employees in relation to AI development and its creation and implementation, tech employees basically are developing their way to a proverbial doom, if you ask me. Even Meta CEO Mark Zuckerberg said they laid off workers in January so they can invest in long-term and ambitious visions around AI, also stating that they operate better as a lean company. And how about tech's net profits? Well, let's just say they're not hurting. So overall, what have we learned from these examples? We learned that the net profits in companies is down overall, which is not good for employment, and unemployment is on the rise. But what about unemployment historically? While there's no doubt that this is gaining steam, historically we're still below levels seen before. In fact, we are now back to levels present back in September of 2017. Mike, this is great and all, but how does this pertain to housing and whether this is a good time to buy? Well, hey, be patient. I'm getting there. In fact, I'm getting there right now. If you're subscribed to this channel and you follow my videos, you would have known by now that really only one thing can affect home ownership in the US today, and that's unemployment. And just in case you want to bring up the '08 Great Recession argument, gone are the days of subprime lending. People today are qualified to be in their homes. But Mike, what about people's finances? While I can see that credit card debt and auto debt is at all-time highs and defaults are on the rise in both categories, housing delinquencies for 30 and 60 days and even 90-day delinquencies are on the decline. Also, foreclosure filings may be on the slight rise, but they're still below levels we saw not even 5 years ago. What all this is telling me is that Americans will let everything go before they let go of their housing. And while pure desperation isn't there yet, Americans are toughing it out. Mike, what do you mean by pure desperation? I mean Americans will do everything they can to hold on to their shelter. Disagree? Let me know in the comments below. Generally, in times of desperation, we would notice a significant rise in HELOCs, for example, and especially right now because Americans have equity in their homes. Although they are on the slight rise, HELOCs still aren't in high demand, and mostly because of the mortgage interest rates associated with them. Why refinance to a higher rate? Again, Americans are still toughing it out. Is personal savings down? Yes, it is, and it's lower than the long-term average of 8.48%. But again, Americans are holding out by cutting vacations or actually even maxing out their credit cards for some of the finer things in life. Eek. So are Americans feeling inflation? No doubt, even this one. But we still haven't cracked yet on the financial front. In fact, disposable income has been up and down over the course of this year. There would be no disposable income if Americans were desperate. As the federal funds rate lowers, however, short-term loans will get easier on Americans and the savings rate should increase. But given all this, what would be the cracking point? Well, again, you guessed it, unemployment. If Americans began to lose their jobs in droves, foreclosures would be on the rise in the housing markets for sure, and this would be an entirely different conversation. So what is teetering unemployment levels in the US? You guessed it again, the federal funds rate. So let's get to the federal funds rate. With recent increases in unemployment and decrease of jobs entering into the US, the markets reacted and reacted hard on Monday. So much so that the Fed can't do anything now but take notice. In the previous months and weeks, the Fed was seeing indications that inflation in the economy was finally slowing down and basically said at their last meeting they plan on cutting the federal funds rate in September. But the cuts being planned just over a week ago were not because of the sharp rises in the unemployment numbers we saw last Friday. At the time of the last meeting, the Fed felt that the US economy had showed them enough of the slowing that they wanted to see, so they would gradually start cutting back. So basically a soft landing. Now, since Monday though, those circumstances have definitely changed. The markets took that data in a hardcore fashion, essentially signaling the Fed of their sentiment or displeasure on how they felt about the current markets, restrictive policies, and global pictures, and how they're turning out. And really, in response over this week, the Fed has more or less pushed back on the markets by a semi-lackadaisical approach to the market moves that we saw. No Fed emergency rate cut has happened yet, nor have I heard really any more talk, so the Fed seems to really be kind of holding out. So given this, the question of what the Fed sees currently, and according to the data, we may never truly know the answer in terms of what it is they got planned. But the one thing that we do know with the federal funds rate or monetary policy is that it typically takes about 6 to 18 months to fully affect the economy. After 8 months of the current restrictive policies that we have in place today, that crack finally showed. So you might be asking me now, Mike, why does it take the federal funds rate so long to work? Well, it's because it takes time for adjustments in borrowing costs to influence consumer spending and business investments. Unfortunately, it just doesn't happen overnight, or the Fed's job would be probably a whole heck of a lot easier. Initially, financial markets might react quickly, but consumer and businesses need time to alter their behavior based on the new interest rates, up or down. Make sense? When they make the cut, additionally, the broader economic adjustments, such as change in employment levels, will also unfold gradually. In fact, on average, it takes about 6 to 12 months for the initial effects of the federal funds rate cut or rise to impact employment, with more significant improvements technically occurring around 12 to 18 months as businesses and consumers adjust to the lowering borrowing costs, if they're making the cut. So, has the Fed held the federal funds rate too long? This is the million-dollar question that investors and analysts alike always try to answer, and it's usually only one that a cut to the federal funds rate can actually determine. But if I were a betting man, I think that they have held it for too long. We'll just have to go ahead and wait and see. So what do the markets anticipate is going to happen with the federal funds rate come the September meeting? Currently, analysts predict that there will be a 54.5% chance the Fed will actually up the game and lower by a 50 basis point cut. However, we will not know for sure until the September meeting, or so it seems like. So is this a good time to buy? Some of you have already processed this by saying no. The Fed has held on too long and the country is headed for a recession. While that might be true, a recession doesn't necessarily mean the end times for you, and the severity may not be as bad as you think. Will this recession be on an '08 level? In my honest opinion, the chances of that are very slim. We'll get to that in just a minute. But overall, if you're thinking about entering the US housing markets in a time of a recession, I would say the most important factor, of course, is your job and how recession-proof it is. Your standing in the company also determines this. While the company is most likely not going to fold in an upcoming recession, they may lay off, or they may not. This is up to you, the viewer, to determine. If you feel that your job won't be on the proverbial chopping block, then the lowering of the federal funds rate has its massive advantages when it comes to the mortgage interest rates. While the federal funds rate doesn't directly control mortgage interest rates, like they do short-term loans like credit cards and auto loans, they do have a ripple effect to them. In a nutshell, when the federal funds rate rises, coupon and or yield rates rise as bond prices fall. Investor treasury selling occurs at a loss so they can take advantage of the higher yields of their new treasury investments. But for the sake of this video, when the yields rise, mortgage interest rates follow, especially pertaining to MBS and 10-year treasury markets. So although the federal funds rate does not have direct connection to mortgage interest rates, they generally rise when the federal funds rate does. They also dip when the federal funds rate goes the other direction. And when the Fed is held on too long and the effects of a recession finally set in, the federal funds rate will drop, and generally drop quickly as the Fed tends to fend off worsening financial and economic conditions in the US. Now, will mortgage interest rates come all the way back to the 3 or 4% range that we got accustomed to when the Fed was doing all of that quantitative easing? Well, if you've subscribed to my channel and if you've been watching for some time, The answer to that question is most definitely no. But with the current concessions offered by builders and even some existing home sellers, they could be. We'll get to that in just a minute. But Mike, why won't rates come back down to the 3 or 4%? First, it's because the rate cut will be one of the first of the many rate cuts that need to follow. The federal funds rate will still be elevated. In fact, as we can see by this graph, the federal funds rate is anticipated to be in the 4.75 to 5% range by the September meeting if they cut by 50 basis points, which is still high. But more importantly, our government is still outspending what it's taking in. This is more critical to mortgage interest rates as more debt is being issued in the form of treasuries. Another reason that mortgage interest rates won't plummet is because the Fed is also in a state of quantitative tightening, where they are selling off their treasury assets. This also adds to the amount of treasuries in circulation. And while the Fed is doing this, so is the Treasury Department. This means that there will be an abundance of treasuries present in the markets, which lowers the value and keeps the yields elevated. Again, supply and demand. As long as they're doing this and knowing that mortgage interest rates follow 10-year treasuries and MBS, mortgage interest rates will stay above the 3 or 4%. Sorry to burst your bubble, but we will not see the 3% or even 4s happen again naturally for quite some time. It could be decades before this comes around again. So now that we know mortgage interest rates will come down, even in the event of a recession, what is going on with the Treasure Valley real estate markets? If you follow this channel and you are subscribed, you're probably well in tune. But if you don't, please hit that subscribe button below, hit the notification bell so that you're constantly in tune with the videos that I do come up with. This will keep you in tune with all information to real estate and the Treasure Valley. For an in-depth overview, please click on the video here in the upper right-hand corner to see what's exactly going on according to the data right here in the greater Boise, Idaho area. You'll also find out the best strategies to buy, sell, or invest in this video. I will cycle this tab as it goes along, just FYI, but for now, and according to the data present in this video in the July 2024 data, inventory is up in both Ada and Canyon counties in relation to new construction and existing homes, with inventory far outpacing buyers' demand in existing homes as compared to new construction. Due to the rise in inventory and the decline in the buyers' demand, new construction and some existing home sellers are offering concessions to entice buyers to their properties. As mentioned, this can be used to buy down the mortgage interest rates, cover closing costs, etc. Okay, Mike, considering the data, what can we expect to happen? Well, we can expect home prices to come down. We sure can. In fact, they already have been. But according to Altos research, some of the price reductions have begun to head in the declining direction. Although they're not fervently dropping in the overall price reductions, they are reducing because buyers are now back in the market, taking advantage of the lower mortgage interest rates and the concessions available. Also, inventory is beginning to decline for a variety of other reasons, primarily due to buyers' demand and really the end of the hot season. Kids are going back to school. But via this graph, we can see mortgage applications have been on the rise, especially as mortgage interest rates have been on the decline. This is the point I want to drill home. This is indicating that buyers are returning to the U.S. housing market. So while those mortgage interest rates have been killers for most home buyers recently, with the expected, just about guaranteed cut in the federal funds rate, we can expect them to continue to lower. When they do, more buyers will come out of the woodworks. And the one that times the market correctly will find themselves having little to no competition, a variety of homes to choose from, strong negotiation power, lowering home costs, lowering mortgage interest rates, and available concessions. Could you ask for anything more? Actually, Mike, yes, I can. How about a market crash? A market crash, eh? I wouldn't get your hopes up there. Again, subprime mortgages do not exist anymore, and homeowners have equity in their homes. Their mortgage is their prized asset today. Unlike '08, when Americans were usually underwater from the get-go. Unless the unemployment rate goes to 20 or 30%, I wouldn't expect a huge amount of inventory to crash into the markets like it did in 2008. Let's hit that with some data. At the height of the pre-recession, the months of new construction inventory was at 11.4 months worth. Plus, at the time, mortgages that were 90 days more or delinquent was at 8.89%. While new construction inventory is rising currently to 9.3 months on a national level, the 90-day delinquency rate is a mere 0.57%. Also, foreclosure filings hit a peak of 556,000 in Q2 of 2009. Where are they today? Just a mere 47,000. So again, it would take a significant increase in unemployment, which is the point of this video. While a recession and subsequent job losses should rise the amount of foreclosure filings and reduce some home value, I wouldn't expect too many homeowners to be affected due to the mortgage interest rate and equity they carry currently on their homes. Plus, forbearance and government intervention could be on the table for Americans if a recession hits. They did so during the pandemic, did they not? These are all things to keep in mind, though. If a recession hits this time around, I don't see it being anywhere near the severity of an '08. So again, unless subprime mortgages make a comeback, when they can't legally, or the unemployment rates to rise to levels we haven't seen since the Great Depression, I wouldn't expect critical inventory volume to come back to the markets again. So Mike, when is the perfect time to purchase going to come around? Well, most think it's going to be now until the September Fed rate cut. I actually have a bit difference of an opinion. But why? Well, it's because now a possible crack seems to be present in the US economy in the form of unemployment. And the Fed is going to have to play catch up if they're smart. This means that they most likely will have to get a bit more aggressive with the federal funds rate cuts. In fact, after the anticipated September rate cut, there's also a 52.1% chance that the Fed will lower again at the November meeting by another 25 basis points. And this will be baked into the mortgage interest rate, and we should see them come down again. Plus, there's a 46.7% chance of another 25 basis points in December, 44.8 in January, and 43.7 in March of 2025. While these are just analyst predictions, if they were to come true, we could very well see a hotter than usual Q4 and Q1 in the real estate markets. As mortgage interest rates come down, buyers will come out of the woodworks as it always does. And again, we're currently seeing that in the mortgage applications. Buyers also currently know that concessions are on the table from builders and existing home sellers alike. As long as inventory stays elevated and the buyers' demand lower, they'll continue to offer them. They will also be offered as buyers' demand naturally slows during the holiday season. Again, it usually does, as does home price declines during the holiday season historically. Given any available concessions, as home prices come down, so also will the cost of buying down a point. And with some builders going as far as to offer up to $45,000 in concessions, that $45,000 can go a very long way, potentially turning a 6% mortgage interest rate into a 4%. That's huge, but the results may vary. So to put this in perspective, at the time of making this video, rates on average were sitting at about 6.5%. So if you bought down 2 full percentage points, you'd be sitting at 4.5. That's going to be better than most consumers are going to see in a very long time. Remember all that quantitative tightening I was talking about? So in summary, conditions are shaping up for a great opportunity for buyers. And while I don't think the September rate cut may be the perfect timing, now is a great time to at least start laying the foundation for a home purchase with your preferred loan officer by obtaining a pre-approval. This costs you nothing except 5 or 6 points. That comes back to your credit report after a hard pull. And if you're looking for a great loan officer, I know many around the Treasure Valley that go the extra mile for you. So please feel free to reach out to me and ask for one of those qualified loan officers in our area. I'll be more than happy to refer you on. But as far as perfect timing, mid-October, according to everything that I'm seeing in the markets, is currently looking like it is around the perfect time to at least start setting the foundation and obtaining your pre-approval. But leave the market monitoring to me and hit the subscribe button below, hit the notification bell since you're constantly tuned with videos that I do come up with. This stuff in the market does fluctuate all the time, and I do come out with videos to keep you informed on what is going on and to keep you informed as to when is the best time to buy, sell, or invest right here in the greater Boise, Idaho area, better known as the Treasure Valley. So, of course, if you are looking to make that move right here, please feel free to give me a call. You can find my contact information in the description below. Also, if you're looking to make a move into our area from out of state, please click in the description below. Download my free relocation guide so that way you're in the know before you decide to make the move. Also, if you are looking to begin your home search, you can find the link down below as well and go ahead and begin your home search via my website, which is a lot more current and up to date than what you can find on Zillow, Realtor.com, and Trulia. And if you are looking to sell, please obtain a free home evaluation below. Click on the link, type in your address, and you'll be provided an automated valuation model. Of course, you'll probably get a phone call from me, but I'm a very, very nice individual and I'm not a pushy real estate agent. So I'll more or less call and see if you have any questions with the AVM and see maybe what your intentions are when it comes to selling your home. And if you'd like to go ahead and set up an appointment and talk about things further, about the best strategies to sell your house for the most money and in the quickest time possible in today's markets, I'd love to go ahead and set up that appointment with you to be able to do so. So again, before you go, if you do find this information useful, please feel free to share it with somebody that you know. It'd always be helpful. And also, please give me a thumbs up. It definitely lets me and it lets the algorithm know that I'm coming up with content and good content that you wish to see. Also, if you feel that I'm totally wrong, challenge is out, everybody. Please leave me a comment down below. We'd definitely love to hear your thoughts on what's going to happen here, how this is all going to pan out. And I know there are a lot of opinions according to what the markets are showing us. But either way, I do see some windows opening up right here for buyers to come into the greater Boise, Idaho area. And I look forward to speaking with you as you have further questions or you're looking to move forward in the purchase process. Well, thanks again very much, everybody, for taking the time out of your day. God bless. And I look forward to calling you my neighbor.